Hi, my name is Shauna Bothold. I am a board member of the Ronald McDonald House, and I'm here to talk to you today about planned giving. I am a partner with a local law firm, Randall Danskin, and have been practicing for 28 years in the area of estate planning. So I'm happy to talk to you about what planned giving is, what that might mean for you in your estate planning. The first question I get asked a lot is, what is planned giving? What does that mean? Most of you are used to making donations to organizations of your choice out of your cash flow. That is not what we call planned giving. Planned giving is something that is more part of your overall estate plan. You might hear it called legacy giving, or your overall financial plan. So it is something that typically is more significant, that fits into your broader planning of what you want to do with your asset. Planned giving can be gifts that you make during your life. They can also be gifts upon death. And that's probably the most common that I want to talk about today, because the other part of this is people will ask me, is planned giving, once I make a decision, is it irrevocable? And that's sometimes scary to clients, of making that big of a decision. And what I always tell them is, just as your estate plan is typically revocable, your will, your trust, however you're doing it in, these are revocable decisions too, that you can change over time as you work through your own estate and financial planning. How do you make a planned gift? Planned gifts can be made during life. They could be something that is an outright gift, such as a big asset of yours. Maybe it's real property or appreciated stock and securities, or something that feels a little less tangible. Maybe it's artwork or something that you know has significant value to it, but you're not exactly sure what it is. These gifts can be made during life. They could be made in a simple way, which is simply outright to an organization, such as the Ronald McDonald House, or they could be made in a more complex way that uses trusts and different contracts that allows the donor to maintain an income stream from the assets that they donate. Maybe it's an income stream for their life or a term of years, or maybe that income stream is to a lower generation, their children or grandchildren. Those are what I would put in the category of a little bit more complex. That allows the flexibility for the donor to make a big planned gift, but still maintain some benefit to it during their life. The other way to do it is in your estate planning document, and that might be in your will, or maybe you have a revocable living trust, and maybe it's something like a beneficiary designation on life insurance or your retirement account. When I first introduced this and talked about it being part of your estate plan or financial plan, a lot of clients come in and we're talking about estate tax planning, for example, especially for Washington residents or clients with a larger wealth that they're concerned about federal estate tax. Donating to charities on your death is a dollar for dollar deduction against estate tax. I often do computations for clients to show them that based on the size of their estate, their children might be faced of paying some estate taxes on their death. However, if they instead wanted to take some of those dollars that would go to paying estate taxes and instead leave that to charity, that's going to reduce the taxes, and the children often end up in the same net position of what they receive from their parents. So that gets into the planned giving part. When talking about certain assets like your IRA, retirement accounts, life insurance, this is a piece that often clients come in and they want to give something to charity, let's say in their will. And we'll start talking about their retirement accounts, because when your heirs inherit those accounts, let's use an IRA as an example, they're going to pay income tax on those dollars as they pull them out of the IRA. And with the current laws on how that works, that's usually going to be they're going to need to take those assets out over a 10-year period. IRAs become a perfect asset for planned giving, because the charities, as they take those same dollars out, are not going to pay income tax on it. So we try to coordinate that with what you're doing in your will, goals that you have in mind, reducing estate tax, all of that. And so we look at all those assets. Another asset that is commonly talked about is life insurance. Life insurance that, for example, they don't want to give up on, they've been paying into it for so long, but maybe those same dollars aren't needed as much in the estate as they might have been at one point. So the life insurance ends up being a great asset as well, to include the Ronald McDonald House on that beneficiary designation. The one really nice thing about doing the planned giving is that if you're planning it for upon your death, it is revocable until it's not. And what I mean by that is clients come in and we do updates to their estate planning document every so often. The same can be said for your planned giving if you're planning to do it upon your death, so that as you and your estate changes over the years, you have the ability to restructure that planned giving so that it meets both your different needs as you go on. Because as clients come in when they're young couples versus middle-aged and then retirement, their estate planning and financial financial planning does change, but that's the beauty of the plan giving, is you can change that as you go as well so that it meets all of your needs. If you have any questions or would like to hear more about this, please reach out to Ronald McDonald House. We would be happy to talk to you, answer any of your questions. We appreciate you taking the